Welcome back, everyone. I know that my breakout session was lively and enjoyable. We'll now turn the meeting over to the leaders of the breakout rooms, starting with topic 1, AI and cryptocurrency.
Great, thanks, Barb. So, as you suggested, Barb, we had a very lively discussion and deep discussion on both topics. And really, when the task force started out on this, we thought each of these topics could have been its own breakout, but we thought they were both important, and we didn't have enough capacity for 4 breakouts, and so that's how we ended up combining them. So we did cover a lot of ground on both of these topics, particularly on AI, where we went pretty deep. So I'll start with maybe just a bit of an update on preparers' use of AI, which was the first kind of part of that discussion, and then move into auditors' use of AI, and then wrap that up then with maybe some discussion around recommendations that the PCAOB could consider relative to perhaps staff guidance or advancing the thinking relative to what makes sense in the standard setting arena. From a preparer perspective, clearly AI's use is increasing, including things like drafting of footnotes or disclosure memos or accounting memos in the preparation of journal entries, and even in some ways relative to management estimates. And when I say that, I think there's a range of how it's being used with the human involvement, and a lot of this is what, the word I tend to use as an accelerator to get a first draft of something or to help with a process as opposed to being something that's being relied upon. We talked a little bit about agentic AI, which is a newer concept, and most participants haven't seen that introduced yet, but is an area that's being widely explored. When you look at what companies are doing, in terms of organizing data and some of the drafting I described, even MD&A, for example, obviously can present degrees of risk, but you need to be sure that the right human involvement is at the table. And I should say, by the way, that the notes that I'm reading from, we actually use ChatGPT 4.0 to summarize the notes in the discussion. In terms of risks and challenges, there's certainly new and differing risks, and that's, we'll get to that in terms of then the audit response to that. There's risk of misapplication. The tools may not do what is intended, so it's important, again, back to the human involvement. You don't want a black box as well. You want to understand what any tools you're using are doing from a management perspective. And then from an investor perspective, some of the concerns that were raised were the potential for boilerplate disclosure or the lack of acknowledgement in disclosure of new events or matters that should be subject to disclosure. And then we had a contrary discussion to that actually the tools could help you identify if you're missing a new disclosure, or if you've had new events that should drive disclosure in a way that's incremental to something you were otherwise planning. So that goes back again to depending on what tools you might use, how you're using them. Very important. We talked about materiality and the human judgment involved in making materiality decisions, and the importance that the technology not get ahead of that or supplant that inappropriately. In terms of then, again, the human expertise, the importance of CPAs, those with the right technical expertise from an accounting perspective, and the right, again, professional judgments that need to be made in the preparation of financial reporting was something we spent a good amount of time on. We did, and this will kind of go to the auditing piece. It was a good transition. We did talk about auditors' risk assessment and potentially some guidance that could be appropriate, transparency around what management's doing. Many auditors are asking for representations in this space, the importance of governance in this space from a company perspective so that they can develop and have the appropriate controls. And then maybe lastly, I'll just mention independence, making sure that if the auditor is using a particular tool, for example, that management's not relying on that tool in some way in an audit relationship. We thought that the independence rules that exist today were sufficient to address that, but that risk was raised by some in the discussion, at least, relative to some of the tools that auditors could use that management may be aware of. So those were some of the things that we talked about from a management perspective, but I think the highlight of it was that things are evolving, but not to the point where there's the lack of the human in the loop or the lack of the human involvement in judgment such that at the moment it appears that controls, ICFR, for example, aren't changing dramatically because of the nature of the human involvement, and these being more accelerators than something that supplants or replaces. Maybe in terms of then the audit for a moment, AI is being used in a variety of tasks: risk assessment, documentation, whether it be of summarization of procedures performed, it could be anomaly detection, could be contract analysis. Again, as an accelerator, not replacing the human involvement. We talked about various tools that are ChatGPT-like tools, or those tools, Microsoft Copilot, other tools that firms may have developed. And again, some of those might be for administrative tasks, some may be for audit purposes, but what's important is really understanding their purpose and limitations, providing the right guidance, any disclaimer language around them, and instruction and the like for teams that may be using them or are using them, to make sure that they're using them appropriately and not over-relying. Again, a lot of discussion around the human in the loop remaining essential, the training being essential, firms' quality controls evolving to address the use of the tools that firms are beginning to use, and then this really being an enabler and an accelerator is something that we spent a lot of time talking about. In terms of challenges and risks, we talked about over-reliance on AI. Is obviously a risk if one goes too far in relying on it in the performance of audit procedures. We talked about making sure that there's the right security and data protection relative to the nature of the tools that are being used, and then certainly that led to a discussion of what the PCAOB may be able to do in this space. I think there was a good amount of consensus that there are areas that the PCAOB could further from the prior spotlight, but probably more in a principles-based way, given how quickly things are emerging. Those went to things like the right human oversight, the right application of professional skepticism, supervision and review concepts, making sure that there's the right consideration of relevance and reliability, frameworks around discussions with management and audit committees is important, and the right kind of open, transparent disclosure were all areas that we thought, again, there's existing concepts that are adequate in existing PCAOB standards, but bringing those to life in this context as an extension of your prior spotlight in the terms of guidance could be useful. We did, by the way, on this also talk about a question that auditors get a lot is, does this reduce the cost of the work performed by auditors? And we had a fair amount of discussion around that, and clearly firms are spending billions with a B dollars. Largest firms are spending billions of dollars in new technology, including the use of artificial intelligence in conducting work. And companies, when we talk about new and emerging risks, likewise are accelerating in this space. So in many cases, we may be spending more, and there may be a point where things are more stable, where you see that come to an equilibrium, but that there's good, transparent discussions happening with management and audit committees who are interested in that. We get that question as auditors frequently, but there was a good dialogue around that. So maybe I'll just pause there, just in terms of AI, before I move on to crypto, to see if anyone that was in the session wants to add anything on AI. Okay. So we had a slightly shorter but also very robust discussion around crypto, and obviously it's a space where the regulatory landscape is changing. There was acknowledgement of some of the statements that have been made at the commission by Chairman Atkins and the committee that Commissioner Pierce is leading, and some of the remarks by Commissioner Ueda in this space. With the changing regulatory landscape, it's clearly a time where the SEC has at least indicated the likelihood of providing more certainty and whether it be regulation, guidance, rules around how this space evolves. And we thought in this space, it's a space where the PCAOB would have an important role to play relative to the audit in this space. So we talked about ownership and access, safeguarding, and we talked about sole ownership concepts, and that some of these concepts are ones that in this space in particular, it can be easy to, from an audit perspective, talk about them and suggest that you're all in a similar place among the profession, but when you get into the details, it may not be the case. And so That could create user expectation gaps for investors and other stakeholders that use the reports, and also important to think about what management's own obligations are when you think about either COSO, when you think about books and records requirements, when you think about internal accounting control requirements for companies in the issuer space, for example. Important to start there relative to some of these concepts and then think about it from an audit perspective. One can go fairly far when you think about safeguarding of assets, and when you think about sole ownership, just because one has access doesn't mean you have ownership. Just because multiple people have access doesn't mean those other people who have access to a key, for instance, doesn't mean they necessarily have ownership rights. And so it gets very complicated, can get very complicated very quickly, and there are a range of risks and a range of how far management might go in terms of their controls and auditors might go relative to the auditing in this space. Talked about the work that the AICPA has done here relative to the guidance that they have issued, lots of guidance around some of the topics that I've mentioned and many others, and that we thought that that could be a good starting point for the PCAOB, but probably something that needs to be evaluated in terms of guidance that the PCAOB may think about picking up from what's been done, or even extending that from a guidance perspective. We talked about the importance of staying aligned with the SEC and making sure that there's good collaboration among standard setters in this space and rulemakers, the SEC, the FASB, what the AICPA is doing, and then obviously industry experts. And then we did talk about some of the risks in addition that go maybe to potential lack of knowledge or experience, skepticism that needs to be applied, and those types of things as well. In the public company space, we noted that material holdings tended to not be commonplace, although it is becoming more common than it had been. And so it is a good time for, I think, the PCAOB to note that in terms of thinking about things that they might do. So just looking at my notes to see if I missed anything there. Use cases I missed. So, beyond crypto holdings, obviously different use cases, whether it be when you think about mining, when you think about staking, lending and borrowing practices in this space. Clearly, as you think about more complicated use cases, it's an area where, again, the AICPA's moved in a direction of guidance, but I think important for the PCAOB to follow along and think about whether there's things to do in terms of bringing a level playing field and consistency relative to what's done in the public company auditing space for the benefit of, again, certainty for those performing work, the audit work, but also for users of reports to understand the nature of the auditor's responsibilities. So maybe with that, I'll pause again there to see if anyone wants to raise anything that I missed that was in the room on this breakout session. Okay, so those covered the summary of those two topics.
Okay, so thank you very much for that, Brian, for everyone that participated in that breakout room. If I could now hand it over to Jim Hunt to go through the audit marketplace discussion.
Thank you very much, Danny. Like Brian, we had a very robust discussion on the broad topic of the audit marketplace, and you can read that to mean alternative investments into accounting and accounting firms. The background was based on 4 pre-reads, including both topical information from within the profession and a very deep academic paper written by 4 professors from the University of Connecticut that looked into this. And in fact, they sequenced and discussed some additional academic research by our own Dr. William Smith in the group. We asked 2 questions, one having 4 parts and the other having 2 parts. And when you come down to it, during a very robust discussion, it came down to 2 real significant issues: independence and quality. And beginning with the end in mind, about a third of the way through our discussion, we decided to actually make a recommendation, and that is the consideration, at least, of establishment of a task force on independent sources of capital. And the reason for that recommendation is because while the first really discussed alternative sources of capital occurred with the Eisner firm in '21, it's still a very new and evolving part of our business. And while private equity is the centerpiece of discussion, there are other alternative capital sources, including ESOPs and other private credit and things of that nature. So the recommendation was based on the consideration that perhaps the PCAOB, the SEC, maybe the AICPA and others, at your determination, could meet fairly frequently to discuss issues and make observations on the developments of the evolving nature of these structures. I'll hasten to say that the National Association of State Boards of Accountancy have a great interest in these alternative structures and are also considering whether or not some further discussion is recommended. Whether or not this task force came together to make some recommendations on independence rules, whether they maybe needed to be updated as they arise, as we observe what's going on in the various life cycles of these alternative investments, whether they're PE or other alternative approaches to capital. We think that there'll be a different review at the initial stages, where we feel we are now, at the mid stage and at the near exit stage, and the challenges will likely be very different. So we thought it would be interesting and important to give consideration to those things. Again, particularly with regard to independence. It was mentioned more than once that independence is the core of auditing, and there was a concern whether or not, depending on what the asks were with regard to these alternative sources of capital, whether independence would be slowly and subtly chipped away, or whether it would be just fine as it is. But there were very, very significant discussions around that. Perhaps another recommendation is some spotlight guidance, not standard setting because of some need for flexibility given the newness of this, but highlighting the risk to quality when considering alternative investments, again, particularly PE firm investments, with particular focus on what's happening today. It seems is that a number of smaller firms are coming together quickly and growing very quickly. And there was the consideration and the discussion of whether quality control systems needed to be considered more specifically when taking in these types of investments. PCAOB, AICPA considerations of inspections specific to quality control systems of the firm and how to address the alternative capital fund environment. And you can see right off the bat the issue that would cause. If one firm has bank debt and another firm has PE debt, wait a minute, you inspect me differently? That's not to say that some consideration of what the risks and consideration, or what the risk and the thoughts are in that would be very, very important. It's an early stage, and we had the great benefit of having someone in our midst that was in the first 52 days of having received private equity investment, and so we had a real life. Steve, I hope you don't mind if I mention you there, but he was real life and really part of it. And to be specific, since I did kind of call him out, he sees no real issues at this point. Things are progressing as usual, but the thing that we each discussed is, do these things change over time? Because again, irrespective of the type of alternative investment capital that's coming into a firm, there are return expectations. And what are the different pressures that those return expectations might present? Now, we were trying to be very specific and thoughtful about the consideration of, in an existing partnership, each partner still has certain pressures on his or her book of business, the profitability of the audit practice, et cetera, et cetera. So experience so far in the early stages, again, no change in audit quality yet, but the consideration of independence is important. The PE investments seem to come with the view toward the 3 T's, that is talent, technology, and transformation, and we had a specific focus on transformation. Transformation generally is translated to mean investments in firms that will do non-audit services. And the other specific consideration we gave to that transformation is there's probably a desire, at least, or maybe a requirement, that the transformation happens quickly. In the pre-reads, we saw instances where firms that were coming together that were $1 billion in total revenue within a short number of years became 3 plus and up to expectations of up to $6 billion of revenue. And whether or not the speed of those transformational efforts would have an impact on firm culture. Whether an ESOP or PE funding or some other alternative types of funding will be coming in, and we think that the pressures ultimately from investors would be the same over the longer term because there is an expectation of return. There is an exposure draft by the AICPA's Peak Committee on Alternative Practice Structures. So it was offered by our colleague from the AICPA to take a look at that and be prepared, if you would be so kind as to, write some comments about the exposure draft. We talked also about culture in the firm and the importance of having a good culture, and particularly in the audit practice. Now, I'll hasten to say also that in some of these alternative investments in accounting firms, the firms that are making the alternative investments don't have an interest in sometimes doing any investments in firms that are doing public company auditing. So they want non-public company auditing, and they particularly want other related accounting services, including moving in, as we understand it, to things like wealth management services. And so those are new. And so that led to an entire discussion about the culture of the firm, and not only the culture of today's firm, but the culture of the firm after some of today's most senior people begin to move on, retire, et cetera. What is the culture that comes behind them, especially as we're bringing undergraduate and graduate students into the firm that have a different perspective, and now their perspective will be from the viewpoint of this alternative investment structure, and how does that impact? One of the day one issues that was very important in the discussion was what does the restricted entity list look like? All of a sudden you have investments by new enterprise. That enterprise has portfolio companies and other enterprises, and there's a restricted entity list that on day one you have to understand, but recognize that even on day one, that restricted entity list changes pretty rapidly, and there's consideration in the quality perspective, to stay on top of that and understand it. We obviously talked about specific training about, again, in the audit practice per se, is, certain clients have different return profiles, et cetera. Certain expectations are different now, and what kind of difficult discussions that we had to have at the client level. The big question that we discussed was what happens in the exit strategy. Is there an exit strategy? Does the firm have any control with regard to the exit strategy? And we recognize the 3 or 4 forms. You could sell on to a strategic, you could do an IPO, or as what we see sometimes in lesser beneficial economic environments, that firms that were acquired by PE get sold to other PE firms. And ultimately, there's a risk that those firms that get sold to other PE firms after a couple of turns may appear to be shop-worn or quality impacted. And so how do we think about that? So those are some of the notions that we had. Some possible issues, again, independence with regard to the PE firms and the relationships and the other firms that they have in their portfolio companies, and how do you manage that? What does the pressure look like from the EBITDA expectations, perspective? Does that change from today's general partnership, where you have some pressures on revenue and the growth of the firm, but does the speed of the expectations of those EBITDA and return matters really occur? There was a pretty robust discussion on the fact that some of the alternative investors in these firms don't want to do any public company auditing at all, and whether or not that could lead over time to kind of 2 tiers of audit quality. The audit quality of those firms that are inspected by the PCAOB, and those firms that are not in the public arena at any level and do not have any kind of inspection, and whether or not there are 2 tiers of audit quality, and how we really had to guard against that almost at all cost. Possible misalignment between the alternative funding and what the historical apprenticeship model looks like. I want to be out of the business in 5 years. I want to do something to flip it. yet, the longer model of the apprenticeship is a much longer-term view. And how do we match culturally the longer-term view of the people coming into the profession with the people that are managing the profession? We talked a fair bit about the underlying governance of the new enterprise or the newly invested enterprise, and we were happy to hear that from an inspection standpoint with regard to public company auditing, the PCAOB has the capacity and does ask for underlying governance documents. But the point was made, if you are just someone who wants to get an audit done of your company and you want to understand this company that you're getting involved with, you have to go very deep, if you can find it at all, into their website to understand what the really underlying governance was. And so the exposure and the exposition of the underlying governance documents is important, again, available to the PCAOB, but we wanted to ask the question of how it goes in other non-PCAOB kind of companies. So I think I'll stop there and ask my colleagues to augment anything I might have missed in the very good summary that were given to me. But I'll stop there and ask, please.
Perfect, and go ahead, Steve.
So to add some context to what Jim just said, and as I go online, I know Jim is cringing because he says, oh no, he's going to take up the rest of the afternoon talking, but I'll keep this brief. The others might be, I agree. But Jim, that was very well put, and you, Akiko, and Ekaterina from the PCAOB did, I think, a really excellent job of synthesizing that information. You guys could give ChatGPT a run for its money, how well you synthesized what was a robust discussion. And when you said earlier on about how I said there was really no changes, just to add some a little more context to that, is that these issues that were brought up regarding pressures on profitability, the independence considerations, the issues with merging in firms that may come about, that's nothing new, and that's something that exists. However, the velocity of that, the volume that comes forth when you have so many firms coming together that you brought up, and the rest of the breakout session members brought up as well, a lot of very valid considerations. And in terms of us, in terms of when I said there was no change, we're very much alert for the changes that may come about and the quality risks that may be out there. What's really the change is that restricted entity list has grown, so to speak, because there's some new names that go there. So when I say there's not been some change, we're very much alert for it. It's just that the reality is we're still committed to serving the public interest, and our responsibilities still really are the same and held true.
Great, thank you very much, Steve, and go ahead, Haley.
Thank you. I just wanted to make one small clarification on the peak paper, in that it's posited as a discussion memorandum instead of a formal exposure draft. I think it's an important distinction because the results of the feedback that is received could result in the need for an interpretation, which would be then exposed, or non-authoritative guidance. So wanted to make that clarification. Thank you.
Perfect, thank you. So Jim, did you have anything else to add, or shall we move on to the next session? Okay, great. So I'll now hand it over to Preeti Chowdhury, who will take us through the topic on the uncertainty in the current economic environment. Before I do that, I do just want to flag, please don't feel restricted by time. We can run over in this session and we'll make it up in future sessions, so please take the time that you need to debrief.
Is this on? Yes, great. Okay, so we had also a great discussion. Just as a reminder, our discussion topic was about the general uncertainty that exists in the marketplace from a variety of things, which I won't go into, but basically what the audit implications are of that, and what, if anything, should the PCAOB do to ensure that we still get high-quality, robust audits. So our lead recommendation was to consider doing a spotlight, very similar in nature to the COVID spotlight, but we went into more detail about what the spotlight might cover. So we thought that there should be a framework to assess uncertainty, and also maybe to organize the spotlight into topics that drive uncertainty, as well as underlying audit issues and procedures, and then lastly, a piece on Q&A for miscellaneous items. So just to expand in more detail, we thought that some of the key financial statement items that might be worth pointing out to auditors is that there needs to be more attention paid to critical accounting policies, the completeness of those policies, and discussion of how risk and uncertainty might affect them, specifically to tie them to and make sure they're consistent with the risk factor disclosures. We also talked about impairments, specifically the interpretation of substantially exceeds, which is in Financial Reporting Manual 9510. That this could be, the interpretation of that may vary, but that the cushion for substantially exceeds probably has gotten smaller and should trigger more careful considerations of impairments. We talked about debt covenants and going concern assumptions that are likely going to be affected by greater risk, supply chain issues, inventory valuation. We talked about long-lived assets, specifically the useful lives, that those may be affected by risk and uncertainty as well as intended use. NOLs and valuation allowances, which require future projections of profitability, are also to be affected, and contingencies. We talked specifically about the fact that discount rates underlie a number of financial statement items, such as debt, goodwill impairments in discounted cash flow analyses, investments, pensions, leases, asset retirement obligations, and that these discount rates are expected to go up if there's more risk. And so this should trigger, more careful evaluation in a number of places. This might be useful to point out in a spotlight guidance, and also specifically that it might be beneficial to have more robust discount rate sensitivity analysis. Lastly, we talked about more emphasis on subsequent event procedures in light of the uncertainty that exists in the marketplace. Then we moved on to a related topic about disclosure in uncertain marketplaces, that it's useful to emphasize fair presentation across the financial statements, and that auditors may want to consider evaluating patterns in financial statement items that might require early warning signals or disclosures. We also talked about risk factor disclosures. Auditors should pay attention to those to make sure that they distinguish between actual events and potential events, because there's been litigation around that. We also considered, or very briefly discussed, that in the past the PCAOB has abandoned their read and evaluate proposal for other information. The current standard references read and consider, but there was some discussion about whether that should be reevaluated. We also talked about guidance could point to specifically ASC 275, that there needs to be more focus on that because of the vulnerability to estimation from risk. Our discussion encompassed the topic of materiality in particular, that in uncertain times it's important for firms to apply materiality rigorously, that the materiality thresholds might require updating given current volatility and risk environment. Specifically, there might be adjustments to tolerable misstatements that should be required, and that we should make sure auditors avoid the Sally behavior, same as last year, because things are not the same as last year. We also talked about CAMs, that we would expect more CAMs given the uncertainty. We hope that that's what we'll see in the marketplace. CAMs, of course, reflect areas of judgment, and we would think that would increase in times of uncertainty, specifically related to impairments and other places that there are financial statement projections. Hopefully, we'll see CAMs on that. We also talked about how auditors could sort of look back at their own work and consider which areas or places they had done more effort in the current year, and that might generate the need or thought to have new CAMs. And then we had a discussion that it might be useful to remind auditors that gaps in CAM coverage can sometimes turn into civil litigation risk issues. Lastly, we talked about the use of specialists and that we would expect more complex valuations to occur and more use of specialists given increased risk and uncertainty. So Spotlight could cover that as well. I'll open it up to see if anybody in the room or otherwise, anybody at all, wants to add anything to this topic. Go ahead.
Hello, my name is Jim Fries, and it's the first time that I have the opportunity to speak in this group as a new member. So thank you for letting me be here. I was not in the last session. I was in the first session, but the point that I feel compelled to make, especially as a non-CPA, but in a way more of an investor advocate, is a lot of the issues with which I don't disagree are very much at a micro level, but when I looked at the topic and uncertainty in the economic environment, I thought it's very important that we consider also the macro level, but specifically the importance of the access to capital formation, the ability for public issuers to access the markets, and from an investor protection, the ability and trust that the investors have. And that's not something that we just do for the US, we do that for global markets, both for global issuers as well as for global investors. And although I've spent half my career in Europe, and I started my day today with calls in Japan and then Europe long before we came here, I pride myself as a former government official here in the US of the deep and trustworthy capital markets. So against that, I wanted to specifically say that with Europe, when I was last year, a week ago, and when I go back, the biggest single topic that is a national security topic is their so-called Savings and Investment Union, formerly known as the Capital Markets Union, but they look to the US and they look at the US capital markets as the global model in things that they need to do better to utilize investor savings, put them to productive uses, and increase innovation and efficiency as the only way to deal with the crises or challenges of aging populations, all aspects of digitalizations, sustainability transformation, against the notion that with record debt, and we saw the downgrade of US government debt here, that there is no alternative to using private capital. The government is not the solution, and that's not a political issue. There's just not enough there. And I say that against Chair Williams' initial comments referring to the origin of the PCAOB after Enron and the WorldCom. Well, 5 years ago, I went in a matter of days, helped unravel and uncover the Enron of Germany, which had involved all four of the big four global auditing firms and a couple more of the top 10. Did involve CAMs, key audit matters that were looked at year after year in the billions, and spurred reforms. Frankly, a lot of those reforms were things that the US implemented in Sarbanes-Oxley, and they only got around to doing it a couple decades later. And this is in the world's third largest company with a stock that is one of the most heavily traded blue chip stocks. So when I think about that, and maybe last comment I'll make is not a topic from today, but from the investor advisory group a couple weeks ago. The initial discussion was, who are the beneficiaries of the audits, whether that's the investor, the CFO as the client, and the like. That's actually one of the most important issues of debate now in Germany. It's before the Supreme Court for hearings that'll go on in October, whether investors could rely as part of their determination reasonably on the fact that it was publicly audited. So I say that against aspects of we, the US, have to continue to lead. That's important not just from a global basis, but for the ability for us to continue drawing the faith of global investors. And it's frankly the trust in the markets that is the biggest differentiator. So with that, I've had some dealings with the PCAOB, but more deep dive in recent weeks in preparing for this. And I see the work is more important than ever. Correctly, as you say, Chair Williams, when you have crisis situations, including in this economic environment, having spent the global financial crisis in the Treasury Department, that's when all the bad things do rise to the top. And that's when we need to be more vigilant than ever. So I hope the U.S. leadership in the capital markets continues, including the work of the PCAOB, and I'm honored to be involved.
Thank you. What a great report back. Oh, one more call.
Really, just a comment on, you talk about the economic crisis and kind of to monitoring that. One thing, we talked about in our session was that AI. And one of the things that we're seeing is the use of AI for actually monitoring all that information. We're seeing lots of companies using modeling with FP&A and coming up with strategies and modeling through all that. So this ability to pull data quickly and change models quickly for preparer is out there and can easily be used and changed rapidly as opposed to 20 years ago in Excel, or Lotus, whatever they were doing in the old days, keeping track of those changes. So just to let you know, I don't know if that came up in your discussion, but that leverage is so important today. Lots of companies are using that for FP&A, and that's going to be the future of FP&A. So I tell a lot of the young CPAs that are out there is like, you got to know the accounting, because what's going to happen in the next 10 years, a lot of this modeling is going to be done by computers, because they can do it much faster, because they can pull in the disruptors that's going on in the global economy. There's an earthquake, or there's supply chain disruption, or there's a manufacturing facility that goes offline, and the CEO and the CFO knows immediately what's going on, because he has everything piped in to his system to actually keep track of all these things that are going on around the world. So it's all connected, and it's going to get more and more connected.
Thank you very much. And I see John White. Go ahead.
Yeah, I just wanted to clarify on the materiality discussion. We were not questioning that materiality is as defined by the Supreme Court, that's the applicable definition. Uncertainty may be a factor that goes into applying that definition, but we were not questioning materiality as defined by the Supreme Court.
Thank you very much. Preeti, do you have anything else you'd like to add? Oh, perfect. And Sandy Peters?
Oh, the one that says on and off. Okay, good. I participated in the AI crypto or digital subgroup, and the comments that were just made, I think, a thought emerged for me during that conversation, which wasn't necessarily appropriate there, but is, I think, appropriate here, which is the fact that we hear coming as investors, coming out of the Securities and Exchange Commission, the old narrative of disclosure overload, including now on executive compensation. And I think that I was just at the IFRS Advisory Council, and we were talking about AI, and I said, disclosure overload is dead from an investor perspective, right? The ability to consume and use information that you're talking about, that companies are using, about investors have been using large language models for a while, right? And so all of this talk has to be considered in the context of investors using this information. And I think it's very important for organizations like the FASB to recognize that, in fact, all of this is an indication of the ability for companies to produce more information, to better produce disclosures, and to produce more useful information, not necessarily boilerplate information. We had that. So I just wanted to add that as an overlay to the conversation that we had about auditing, but it's also the consciousness of investors is quite different about information, and it's troubling to hear a narrative out of the Securities and Exchange Commission now that's 15 years old that we thought we killed. So anyway, I'll just put it out there in the sense of auditing that information.
Thank you, Sandy, and go ahead, John.
Well, Sandy, I couldn't help but add that one has to look at cost benefit in terms of preparers putting this information together. I accept that you may be able to analyze it more effectively, but we should not lose track of cost benefit.
But I think in the conversation, the issue is that people are saying there are tools to produce this information. And I agree with you. Investors are paying for the production of the information, though, you have to remember, right? They're paying for it. They own the place. So I think that while I agree with that, I think that the benefits are always hard to measure. There's a great quote we've used in some of our articles by the former head of the founder of Vanguard that says, the costs are easy to measure, the benefits are hard to measure, right? So I just would say that a lot of the notion is that investors will be confused by this information. They are overloaded with it, right? That is the narrative that we hear that's used to co-opt investors' conversation about the issue. So I just wanted to highlight that we're hearing that again in light of a conversation that is about how we can do all of these new things. That's all.
Go ahead, Dane.
Thank you. I just want to underscore Sandy's point that investors ultimately pay for the audit. So cost benefit, you don't hear investors complaining that they're paying too much for financial reporting. So I do think that that's a narrative that we usually hear when people want to kill something. And I would also kind of speak to something that Stephen mentioned earlier about like, okay, management teams can do more scenario analysis and all these other things. I think an issue that we have as investors is that, you know, the auditors and management teams can have conversations about, you know, the environment and going back to the topic of uncertainty, how they're dealing with the environment. But it's just the issue of that disclosure gap about how much of their understanding of the enterprise actually is translated into the disclosures and that we as investors see. Because oftentimes I think there is a big gap. And so, especially in these periods of uncertainty, I would encourage auditors to give a full read, including the MD&A section, read the entire financial statement, and say, well, does this financial statement, is it projecting a picture of the company that's consistent with management and the auditor's viewpoint of the company? Because I don't know that that's necessarily the case all the time.
Thank you, Dane. Go ahead, Stephen.
I'm sorry. Just to kind of build off a little bit what I heard and to John's comment, I'm a big proponent of more disclosure. I'm not saying that. And the issue that I think I see is it's the accounting of it, not the disclosure. So this is what I mean by that is investors want to know more, and it's in words sometimes. But the complexity of the accounting is what is difficult. Do I need to account for some of these changes? And then it takes a lot of audit time to come up with that complexity is some of the concern that we run into. And the question is it useful for the investor? Does the investor really need to know what the changes are on fair value, as an example? Because at the end of the day, I know, but he'll just understand what's going on in the project, because some of these things they take a long time before they actually get settled. So the question would be I'd like to know what's going on, explain what's happening, as opposed to the numbers. So I look at two kinds of views of disclosure: the words, and then also I'm looking at the actual accounting and the work that's behind creating those numbers, which could be very difficult and very complex. And this is where it gets difficult. You need to hire experts sometimes to come up with those numbers, that's the point that I think John's raising. That's the cost that preparers would have to account for, because those things take time to do.
Sorry, just again to correct the language, that's the cost that investors pay.
Thank you all. John, did you have anything further to add? John White?
I was just thinking about it. I mean, I was actually at the SEC involved in the exec comp rules back in 2006, but the disclosure's gotten enormously longer than where it was in 2006. And I think what Chair Atkins is saying now is that maybe we need to look at this significant increase of beyond what we put in place in 2006, which he voted for, by the way, because he was a commissioner at the time. But Dodd-Frank has added a lot, and there's a whole lot more there, and it may not be clear that you need that much. You can read it faster, but the cost of producing some of it and the effort is significantly higher. But there will be a round table in which everyone can express their views, and Anita, you can fill in here, but I believe that the participants in that round table are still being lined up. So, if you want to raise your hand and call whoever you're supposed to call to be able to participate in the round table, I think you should have someone there to explain who pays the cost.
Thank you. So I'm going to hand it over to Laura Phillips and then Dane Mott, and I think those will be the last two comments just to keep us somewhat on track for time. So Laura, go ahead.
I guess just one more shot in the volley of cost of information. There are, public companies take their responsibilities in terms of disclosures very seriously. So there are audit-like processes, right, that are happening behind the scenes to validate the information before it's disclosed. There's information that companies use at some level of internal decision-making that they don't disclose simply because the reliability isn't high enough. And so I fully appreciate the notion that investors ultimately bear the cost and not to be able to make the decision. At the same time, I just don't want you to underestimate the cost of providing some of this information at a level that merits public disclosure. I'm just not sure the juice is always worth the squeeze on that.
So the first comment is on stock-based compensation. I think I would just point out that the scale of stock-based compensation has grown exponentially over the past 15 or 20 years, by multiples. So, we can think about disclosure expanding, but in many cases, on an annual basis, for some companies, we're talking about numbers in the tens of billions of dollars. And if you go back 20 years ago, I think the whole S&P might have been like 100 billion. So it's gotten much more substantial. So disclosure, explosion is to be expected, especially too because it's got more sophisticated. They're not granting as many like plain vanillas. It's a lot of performance based and a lot of triggers and special elements. And then, ultimately with disclosure, there's going to be elements of disclosure, things that are key aspects of a business where if you're an investor and you're trying to understand the business, there's going to be things that when you go to the financial statements, you have an expectation that those things are in the financial statements. And as somebody who spends every day looking at financial statements, oftentimes the disclosures you would expect to be there are not there for things that are extremely, very key business issues for the business. And, that's just a reality. So, whether it be the way the standards are written or whatever, there's an expectation gap for investors about what we're getting and maybe what's in the codification, but it's a big expectation gap, and for some cases, it leads to just substantial mispricing of securities and risk to markets. And if we want efficient capital markets, we should have the expectation things that are material information are going to show up in those disclosures one way or another.
Okay, thank you everyone for that robust discussion. Given where we're at with timing, we're actually going to move into our 30-minute non-public session, which will be a brief internal update for 15 minutes, and then we'll go into our break. The session that we had planned, we will still do on implementing new and amended standards, but we will then do that after the break when we return to the public live stream. So it is, let's say it's 2 o'clock, so we'll return to the public live stream at 2:30. If everyone